beat indexing is because it's not slavishly having to follow a particular mechanical rule.
We think that there's value to having portfolio managers look at the portfolio weights every day. The major difference over an index is the flexibility to rebalance the portfolios every single day.
It's Jobs Day, and Bloomberg has the report under surveillance.
Markets pay attention to one thing at a time.
It's all about that wage data.
Wages are stabilizing, and that's good news for the inflation story.
Today, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
Are we losing dynamism in this labour market?
We don't have a jobs problem at the moment.
It all comes down to what the data says. How important is that payroll data going to be?
The September Jobs Report, today on Bloomberg.
Take a look at how we're setting up for this final session of the week. A lot for investors to be worried about at the moment, of course, not least of which is watching the developments in the Middle East as we continue to wait for or brace for potential Israeli retaliation there. They have struck Hezbollah targets in Beirut. We're seeing urges of restraint from the US and allies, but continue to watch that given that we're seeing the oil price continue to soar, the dollar also rising on some of that haven demand. Sydney futures at this point looking like we'll see some weakness going into the weekend, as well as Chicago Nikkei futures looking pretty flat at the moment. S&P futures there are largely unchanged, with really that broader focus remaining on what potentially happens to oil prices given this uncertainty over whether Iranian oil facilities might be targeted next. Let's bring in our next guest, who says geopolitical tensions will cause investor angst but will rarely lead to changes when it comes to investment outlooks. With us now is George Vilgares, Managing Director at K2 Asset Management. George, great to have you with us. And, you know, it is true that we've seen this market kind of largely pretty sanguine over the past few weeks and months, when in fact since October 7th last year. Right, we're coming up to that anniversary very quickly next week. But I do wonder whether over the past few days, has that calculus changed somewhat?
Good morning. Good to be here. The reality is with geopolitical, as complex as it is, and it's all about game theory, and we've got the political analysts in there giving their views, it doesn't alter the fundamentals globally very often. And the course of monetary policy synchronization, stimulus, and the ability for PMI to be expansion, etc., the fundamentals are still quite solid globally, notwithstanding pockets of pain around the world. But when it comes to geopolitical and trying to price in geopolitical, it's very difficult, again, because it doesn't lead to a significant shock to global economic activity that's got longevity. But it is a big concern, obviously. But when you're taking a step back, I think markets are overtly surprised the neutralisation of Hezbollah after a year-long campaign against Hamas to deal with that issue in that region. And one would think, as all the analysts are saying, that the pressure will be back into Iran with Israel. They've got an opportunity here to make an impact to delay their nuclear program. But taking a step back from that, the GCC economies are still strong. They're still involved in an export sector. They've still got great savings pools that they're investing around the world. So when we're looking at fundamentals, that's why we generally say geopolitical events are short-term shocks. They amplify the headlines. It makes investors a bit concerned. But it's still a broadly buy the dip on risk narrative to oversimplify the comment.
So if you think that the broader narrative is clearly the global sort of synchronized easing cycle, now you've got potentially a bit of reflation from China coming in with their barrage of stimulus. Is it perhaps a bit more complicated now that it seems like we're getting really a broad picture of US economic strength?
Yeah, exactly. Again, it is more complicated as we discuss on these programs in 5 minutes. But yes, they've got the synchronisation of the major economies, except for the BOJ and the RBA, they're outliers. but the economic activity in the PMI in the US economy is still quite robust. Earnings are expanding. They're not expanding double digit, but they're expanding. It is a broadly healthy environment to make monetary policy easier on that economy, notwithstanding government has a bigger footprint on GDP in North America over the past 4 years and the previous 4 years of that. And then China, notwithstanding, it needs much more stimulus and more targeted stimulus, and it's been stimulating for 2-3 years. But the broad synchronisation of monetary policy is important. There'll be upgrades to global GDP in the next 3 months, minor ones. But the key here for investors is that we believe discount rates, and many others do believe this, will be higher in the cycle ahead than the previous cycle. It'll be a shallow interest rate cut cycle. It'll just be measured and elongated, again, because economic activity is not contractionary, it's still expansionary. And again, there's weak pockets throughout there, and we'll just focus on the monetary policy, but easier policy, shallow cut, and synchronisation of the themes.
Perhaps too expansionary when it comes to the U.S. economy for the Fed to be able to cut at a faster rate. I just wonder how nervous should we be for the non-farm payrolls and the sharp market reaction, given how much easing has already been priced in?
Yes, spot on. We believe too much easing has been priced in. If tonight's number is overtly weak, a significant outlier week, it may go into the camp of 50. But the reality is 25 seems to be prudent, again, because services PMIs are expanding, prices paid components are not behaving themselves. The labour market weakness is there, but it's on the overall scheme of things, labour market is quite strong when you're looking at historical benchmarks and other phases of the cycle and previous cycles. So to be putting more interest rate cuts in the face of expansionary PMIs and a broadly healthy US earnings aggregate market doesn't seem to make too much sense. And that is why everyone's been buying that dip sort of scenario. But we think 25 seems prudent. Market seems to be paring that back. But we do believe the market still has too much interest rate pricing for interest rate cuts, and it just needs to acknowledge that the discount rate will be higher in the cycle ahead, and the earnings environment can withstand that over the next 2 to 3 quarters quite easily.
Given what you've said then, how closely should we be watching the Japanese yen as well, given that the BOJ and the new administration seem to be really walking back those hike expectations at the moment? And should we be focusing back again on the yen carry trades that could be attractive?
Yen carry trades back on in the very short term until you get above 150. That's an oversimplification. The BOJ people may be interpreting the language as being a little bit more dovish versus what they've said in March and in September. But the reality is they're not going to be stimulating or going towards that easing camp. They're on that pathway of slow and measured interest rate contractionary monetary policy in Japan. They worked very hard to get here. But the 160 was too weak on the yen. The 140 was extreme. It impacts their earnings outlook, impacts Japanese earnings, hurts the Nikkei. But getting that towards that 147, towards that 150 now, that seems to make the carry trades back on. But the reality is, depending on what the interest rate cycle is for the US, when they start paring back the interest rate cuts in calendar 2025, you'll see the yen strength from that 150 level, low 150s, back towards a mid 145. So hopefully that made a bit of logic there, but it's a bit of a push-pull effect. But every time that yen rallies, it's going to have an impact on expectations on corporate profits for the Japanese economy.
When you take a look at the China stimulus, the associated, elevation off super cheap levels, is this a bit of a false dawn, do you think, or is this a fundamental turnaround in how we should be thinking about Chinese risk assets?
The risk asset rally and surge has been phenomenal from effectively levels, depending on if you look at credit markets from default rates to non-default rates. The reality is the stimulus for the PBOC in Beijing has been ongoing for a number of years, but up until recently, they finally understood you need to actually get some stimulus to the household level. They've been very reluctant to do so until recently. So it's like a mini bazooka. Their export sector is the best in the world. They've got capacity and efficiency to export the energy transition for decades ahead. So they're number one on that. But when it came to consumer sentiment, business sentiment, and the household, they finally understood you've got to pass some relief onto the household. However, this is the construction collapse that they've experienced on the property sector, this is not a 2-3 year fix. This is a 5-7 year plus fix. So they've got a lot of issues to deal with going forward. This is a nice pivot, but much more is required to pass on relief at the household level, which they've been reluctant to do in China. So we'll be playing China through the exporters to China as opposed to mainland China.
We'll be watching the Chinese market opens next week. George Babura is Managing Director at K2 Asset Management. Good to have you with us. We have more ahead on the Asia Trade. This is Bloomberg.